Every single week, the market hands you the same setup. Monday sets a range, and at some point during the week, price leaves that range, comes back inside, and then more often than not, gives you a trade setup. It happens on Bitcoin, happens on ETH, it happens on basically anything liquid, and you only need the hourly chart to trade it. This is Monday's range, and it's a setup that I've been trading for years. And today, I'm giving you the whole thing. The rules, the entry, the stop, the target, and some real trade examples of winners and losers so you can see exactly how it behaves. By the end of this, you'll be able to mark it out yourself next Monday and maybe even find a trade. Let's get into it. So here's the whole model up front. There's only 4 rules. So rule number 1, we're gonna mark out Monday's high and low. The highest price and the lowest price that we traded on Monday, that is your box. That's your range for the entire week. Rule number 2 is you wait. At some point during the week, we are most likely going to trade outside of that box, above the high or below the low. That move outside is the deviation, and ideally it happens early in the week. Rule number 3, the trigger. You want to see an hourly candle close back inside the range. So if price sweeps above Monday's high and closes back in, we're looking for shorts. If it sweeps below Monday's low, closes back in, we're looking for longs. Rule number 4 is stop loss placement and target. Your stop loss goes above or below the deviation. So the extreme point that price traded outside of the box, that's where your stop goes. Your target is simply 2R. If you want to be more ambitious, you can aim for the opposite side of Monday's range, but 2R is plenty for this strategy. And that's really it. That's the entire system. It's going to happen once a week on basically every asset. You only need the hourly chart and these 4 rules. Let me show you how each one of them breaks down. So step number 1 takes about 30 seconds. Once Monday's trading is finished, you're going to go to your chart and you're just going to mark out the highest point which Monday traded during the day and the lowest point that Monday traded. That is your Monday's high and your Monday's low. It's as simple as that. You can do this from the daily chart, of course. Once the candle closes, just go ahead and mark the high and the low of that daily candle there. There's also lots of indicators on TradingView that will do this automatically for you if you are too lazy. Now, you're probably asking why Monday's range? Why is it important? So we're going to blend a few different concepts here. So hopefully this makes sense to you, but really Monday's range is no different than any range trading strategy. You can mark out a range on a weekly candle, hourly candle. You can visually just take a high and low where you think price is ranging, and you can treat it as a range. If price is proven, hey, this range is actually valid, it's respecting these levels, I can now trade it as a range. If we trade below and back inside, I'm going to assume we're going to trade back to the other side. If we trade above and then back inside, I'm going to assume we're going to trade back to the other side. And I'm going to assume this range is going to continue to range until price shows me that it's no longer interested in ranging and it breaks out either below or above. So Monday's range is no different in essence than any trading range that you're using. Price is ranging between these 2 levels. I'm going to trade it as such. Now, of course, not every single Monday's range is going to react like a range. Sometimes we might just break out immediately and keep trading higher. Sometimes we might break down immediately and keep trading lower. But the idea here is this is kind of your opening range for the week. Oftentimes, people are going to try and position themselves early in the week for longs or shorts, and you're going to see liquidity build up on either side of Monday's range, above the high, below the low, and we're going to look and see if price is going to take out any of that liquidity and then either keep going or continue to range. The last thing that Monday's range really represents has to do with how the weekly candle forms. Now, there's lots of data out there on this, but generally, the lower the high of the week is going to form earlier in the week. Not all the time, but more often than not, on Tuesday or Wednesday, you will find the low or high of the week form. Again, nothing is 100% certain in trading, but go ahead and back test this yourself. Oftentimes in a bullish week, you will see price open, form its low, trade higher for the rest of the week, and then close. You have your open, your low, your high, and then your close. In a bearish week, you'll often see price open, form its high, trade down, then end up closing. Open, high, low, close. Now again, This isn't exactly how every single candle is going to form. Sometimes in a bullish week, we'll go open, high, low, then close. Sometimes in a bearish week, we'll go open, low, high, then close. But this pattern happens quite often, sometimes as much as 50+% of the time. We get this kind of low or high of the week occurring early in the week. So with this in mind, what we're looking for with Monday's range is for an early week move above Monday's high or below Monday's low to give us a clue that this might be the high of the week. So you can see this is Solana here. We have Monday's low, we have Monday's high, and then on Wednesday, we trade above Monday's high, back within Monday's range, and it's now Friday. There's a good chance that this might already be the high of the week put in on Wednesday. And the same logic works in the opposite direction here. If we have Monday's high and Monday's low, if price opens up the week trading below Monday's low and then back in, and this is on Tuesday or Wednesday, there's a good chance that we just saw the low of the week, and we can expect price to now trade higher, or at least higher than here, for the remainder of the week. So those are the reasons why I use Monday's range in this way. It's a way to potentially catch the lower the high of the week, and it's also just a range trading strategy using Monday's candle as that effective range. Let's talk about the actual reclaim, the trade setup now. We have an example here on ETH. I have Monday's high, I have Monday's low, and you can see early in the week, this happens to be on Wednesday. We come down to Monday's low. We put in a nice little sweep, a little over under, break back within, and we end up trading all the way to the other side of Monday's range. This is a perfect example of a Monday's range low long. Now, for the actual trade setup itself, there's a couple different ways I've taught this in the past. The most basic way is the moment you get an hourly close outside and then back within, the trade is on. So you can see here, we got our hourly close outside and then back in. There's your entry. Stop below the deviation. That's already 2R. And you can see this one goes all the way to the other side of the range and actually quite a ways beyond. So that's option number one. You quite literally take it as soon as we get the hourly close outside and back in. You put the trade on, you're in it, you ride it for 2R, stop below the deviation. I call this the basic Monday's range strategy. It's the most mechanical, it's the easiest to understand. Effectively, what we're expecting here is this move below Monday's low is simply a liquidity grab, and that's going to be consequently the low of the week on a Wednesday before price goes and trades higher for the remainder of the week, just like I talked about in section 1 there. However, there are going to be a lot of instances where entering with just this basic mechanical strategy is going to give you a lot of false positives. So the basic strategy, the moment we get 1 hour close outside of Monday's high or Monday's low, wait for 1 hour close back in, long, short on H1 close, target 2R. Okay, so what are the pros? This is simple, mechanical, and it's going to be very kind of black and white. There's no discretion, okay? No discretion. The cons are there's going to be a lot of false positives. There's going to be a lot of chop occur at the highs and lows. So while I think for a beginner, you can quite literally use the basic strategy. And if you go back test this over a long enough period of time, generally, because you're aiming for 2 to 1 R, you're going to still be profitable because it's literally double the amount of money you make on every loss, right? So if you're risking $1, you're making $2 every time. You only need a 33% hit rate to be right. However, if you want to refine this strategy further, the other pro here is you're going to get, I guess, more signals, but that's also a con. You're going to get more signals. But if you want to refine this further and have a higher hit rate where you don't get stopped out as much, I think you want to do the following, okay? Only count trades on Tuesday and Wednesday. Meaning if that deviation doesn't occur on Tuesday or Wednesday, it's irrelevant. If it happens on a Thursday, happens on a Friday, you're not taking that trade. Look for additional PA confluence. Do we get a Market structure break. Is there an order block, a breaker block, a fair value gap? Is there displacement? Is there an SFP? Anything that might give us a clue that indeed we're not seeing, just a closeout and back in. We're seeing a clear liquidity grab, a swing failure pattern, and that reclaim, that deviation is legit. Use your high time frame bias. A Monday's range low long is a lot higher probability if we're already in an uptrend. A Monday's high short is a lot higher probability if we're already in a downtrend, okay? So by adding these additional pieces of confluence here, I think you're going to have the pros, right? Higher hit rate. You're going to have probably better RR because you're entering in a more precise way. And I think your trades are going to have the potential to run farther due to high time frame bias. Less false signals. The cons, there's going to be less trades here. Requires discretion. That's not really a con, but that's something that you're going to have to learn over time, okay? So the basic strategy, just like we showed you here, as soon as you get that hourly close back within, I think you can go ahead and enter. How would I enter this in the refined way? And why might this trade be a better trade using the refined setup? Well, we have a move below the low here, and then we have a sweep and then a higher low here right into an order block. So rather than just entering on the hourly close, I could say, hey, I'm actually going to enter on this order block. That entry is actually a little bit tighter. Okay, I'm entering on the down candle for the up move that broke us back in there, put in a higher low. We also now have an SFP that occurs right here. That's some additional confluence that this setup's going to go. We have another order block right there. That could be a second entry where you compound. And using our higher time frame bias, we're in an uptrend. This is bullish price action. Even on the daily chart, the daily is clearly in an uptrend here. We broke that high. That's a higher high on the daily that we just formed. So rather than just taking profit at 2R, you might say, you know what, we're in an uptrend. I'm going to ride this thing all the way to the other side of the range. And the reason you're able to have that context to hold on to this thing longer is because you're looking at the high time frame. You have this additional confluence with the order block, some of these other price action items, rather than just this very rudimentary way to do it. So the basic strat absolutely works. But in terms of finding the deviation, fine-tuning your entry, using some of these items to filter out bad trades from good ones is really going to help you turn the strategy into a full-on edge. You can raw dog this basic strat, and I've had it work where I'm literally just doing it super, super basic for a while, but there's going to be periods of time where this doesn't work at all and it gets absolutely annihilated because we chop here. And are you going to enter every time it closes back in? Of course not in real life, but there's going to be periods where this doesn't work. There's going to be periods where this works really well. When you add these kind of refined items in here, it becomes a more durable strategy that's going to work in all market environments because you're going to filter out some of those bad trades with some of these things here that might get picked up here. So now let's go over a bunch of examples of Monday's range over the past few weeks across a variety of different assets, and we'll talk about the refined and basic strategies with each of them. Just to be clear here, Monday's range has not been super good lately in crypto because the volatility has been super low. So we'll go over some crypto examples and then we'll go over some examples in other markets as well. We're going to start here with Ethereum. I've marked out Monday's range going back like a month and a half here. So going all the way back here to June, Monday's low, Monday's high, we trade below Monday's low and just keep trading lower. There's no trade there. This is 30 seconds of work, by the way, for a potential trade setup every week on every single chart. We go to the next week, you have Monday's low, you have Monday's high. Now, cherry picking here, you might say that, hey, I mean, this is technically an SFP of Monday's low. That could be a setup. Maybe if you're really scalping or if you're really looking that close, but this is like an SFP by like less than 10 cents. I'm not going to cherry pick and give us that. Let's just assume no trade here either. You can see we get above Monday's high here, sweep it. This next deviation, it's already on Thursday. Like this week is already played out. Remember, we want this to happen early in the week. Here's the one that we used in our example earlier. There's your Monday's low, Monday's high. We trade below Monday's low on Wednesday, back inside. This is a great trade. You're definitely getting 2R on ETH on this setup here, either with the basic entry, which is right at the hourly there, stop below the low, or using maybe some of the more refined entry techniques, the SFP, the order block, an opportunity for multiple entries. Really what I want you guys to understand here is Monday's range as a concept is very basic, but when you understand the logic behind it, the open, high, low, close, open, low, high, close, like I described. When you understand range trading as a concept, Monday's range becomes actually quite powerful because it's a framework that allows you to determine your bias, which is the number one most important thing when you're looking for a trade setup. Are we going up or down? And then subsequently apply all of the other price action concepts that you know. So if based on Monday's range, I know that on this reclaim, I'm now bullish up towards as high as Monday's high, right? I now have bias, arguably sometimes the hardest thing to figure out in trading, done, right? Everyone's always asking, what's my draw on liquidity? Are we going up or down? Well, this framework of Monday's range lets you know if we sweep the low early in the week and reclaim, there's a good chance we're going to trade higher into the end of the week. Not always, but a good chance. Okay, I don't even need to enter here. My bias is bullish. I'm now looking at an hourly chart, but I've got bull goggles on. I've got a low, a high, a higher low, a higher high. I see an order block here with an SFP. Is that not a setup on its own on the hourly chart? We're in an uptrend. I'm buying a pullback into a bullish order block with an SFP. I got bull goggles on. I'm aiming for Monday's high. My bias is already set out. Is this not also an order block right here after a higher high? Higher low, higher high, higher low. Is this not even a setup here? Order block, tag, moves up to the range high. So it's not necessarily that you can only enter here. I know I'm getting a little bit off track here, but this idea of it just being a basic thing from Monday's high and low, that's only part of it. We're giving you a framework here to determine if you think price is going to go up or down for the remainder of the week. And that's what that entire refined strategy is here. We're using Monday's range to determine, do we think the week's going to close bullish or bearish based on this reaction at Monday's high or low? And then you can go and apply any sort of price action concept after that and long bullish order blocks. Why? Because we're bullish on the high time frame based on Monday's range. Or of course, like I said, you can just enter based on the basic strategy, which is as soon as we get the hourly close back with inside, we're entering, stop at the deviation, target 2R. So you're at least 2R so far on ETH. Let's go over here. No trade. High, low, we trade outside, well above, right? We come back within, but this is already Friday by now. There's no trade there. This is one where, depending on whether or not you're using the basic strategy, the refined strategy, you might get stopped out or you might avoid a trade entirely. So according to the basic strategy, the moment we get this hourly close back within here, you would have taken a short right here, stop at the deviation, and likely immediately have gotten stopped out. You might have also entered again based on the multiple stops that occurred, multiple breaks that occurred here. We broke back in here. Do we short again here? Do we short again here? Not necessarily. I mean, this one, maybe you take a second attempt, probably get stopped out again. But this one occurred on Thursday, so you're definitely going to be filtering that one out. And generally, a good rule of thumb is if you're stopped out on the Monday's range trade already once in the week, that range is done. Don't use it anymore. Is there going to be instances where, it trades above the high, right? Stops you out and then comes back in? Sure. But then I would want to be using the refined strategy. Is this an SFP? Is there a market structure break? Is there a reason that we got kind of this double dip? Then by all means, you can go and try it again. But on this one, let's assume negative 1R at least. Another thing that jumps out to me on this one as well, a really easy filter, is if the deviation is really far from where your entry would be, to the point where targeting the entire other side of the range doesn't give you 2R, it's not a good trade. If you remember on this one over here that worked, we were only halfway into the range and it was already 2R. Here, your stop loss is $50 away from your entry, and it would have to go all the way to Monday's range low, and it's still not going to give you 2R. Probably not a good trade. I think due to the refined system, I probably wouldn't have taken this because we kind of had a breakout here, and then we didn't really break back in. Yeah, it closed back within, but to me, not with any sort of displacement or fair value gap. It actually swept here, which makes me think it wants to go higher. This is a strong break back in, but at this point, we're too late in the week. Let's assume we took this and took the L. We're now up 1R. New Monday's range here. This is an example like I was talking about of kind of the double. You have your high and low. We traded below. You enter here, stop there, you get stopped out. Only for price to sweep that low and then break back inside before trading back into the range. Do you take this one? Basic strategy says you're going to take it at least once and get stopped out. Refined strategy, you might take it twice and make some of your money back on the second setup here. So the second setup on the SFP, there's enough reason for you to enter off of that SFP. Okay, that was a fake out. And if you took the first one, well, the second one pays you 3 to 1R or even 2R. It's a bit of a wash. It's going to be up to you. But I don't want to cherry pick here. Let's assume you took the basic setup. You get stopped out there as well. You're now 0 for the last 4 trades, right? You have a win, 3 losses, or a win and 2 losses, over the last 3 trades. You're at 0R. High, low, no trade here for the week. So that's 4 trades covered for ETH here, and you're at break even using the basic strategy only. Now, if you would have used the refined strategy, maybe you're up a couple R at this point. But like I said, this isn't the best time to be using Monday's range on some of these crypto pairs because the volatility has been pretty low. However, if we go over to Hyperliquid, Hype has actually been trading a little bit more volatile than some of these other crypto pairs. And Hyperliquid's also been in a more clear downtrend. This has been in a downtrend for pretty much all of July. So let's go ahead and look at the last handful of Monday's range trades on Hyperliquid, keeping in mind that our high time frame bias is to the downside. Monday high, Monday low, we sweep out Monday's high on a Tuesday, right back within, all the way to the other side. You're definitely taking this trade, either basic or refined. Either way, that's a 2R trade. Monday's high, Monday's low. You could argue that we swept Monday's low here and you took a long, but then we absolutely take out Monday's high here on Wednesday for a short. So refined strategy, to be honest with you, I'm personally probably taking both of these trades, the low and the high, but this is for sure a classic Monday's range high short. Basic or advanced kind of refined strategy, either one, you're pulling trigger here. That's another 2R. And this one, just like the one before, it goes all the way to the other side of Monday's range. Here's another one. Monday's high and low. We trade above Monday's high, back within. You take the short all the way to the other side. That's another 2R. And here's another one. This one probably doesn't have a trade here. Monday's high, Monday's low. We break down. Uses it resistance. By the time we're here, it's already Thursday. No trade. And here's one where maybe you get stopped out on it here, depending. Monday's low, Monday's high. We trade above. We get a close back within. Then it trades higher. Let's not cherry pick. Let's assume you took this negative 1R. So your -1 plus 2 is +1. Plus 2 is +3. Plus 2 is 5R. So on Hyperliquid, over the last 5 weeks, you've got 5R just using the basic Monday's range strategy. Potentially even more if you use some of the refined stuff that I shared with you. Whereas on ETH, maybe you're break even, maybe you're +1 or 2R, just using Monday's strategy. All right, guys, that's it. That's my Monday's range trading strategy. As you can see, it's very easy to mark up, very easy to understand, and it's available every single week across all assets. I wanted to give you both a basic mechanical strategy that you can start applying right away, as well as the refined strategy. The basic strategy is good, but there's going to be periods of time where you get those false positives and your hit rate might not be amazing. The refined strategy should be something that you can absolutely jump into if you watch the trading course on this channel or any of my whiteboard series. All of those concepts I mentioned should be very familiar for you, and they're just going to help you filter out bad trades and get the most out of good trades. Like you saw, there's going to be periods of time where this works okay, like on Ethereum, where we effectively break even over the last month. There's going to be times where this works really good, like on Hyperliquid, where it was +5 or 6R over the last month. So what I want you to do is hop into your charts, start marking out those Monday's ranges, and start looking for these setups, and let me know how you do in the comments. I'll talk to you guys in the next one.